Hello, everyone. Welcome to our search and matching workshop seminar today. We're very happy to have Levent. Today, he's going to talk about collective moral hazard and the interbank market. And we also want to express our special thanks to the panelists who can join us today. As a reminder, we have a 15-minute Q&A afterwards. Okay, Levent, the floor is yours.
Okay, let me just share my screen. Okay, I think you should be able to see the screen. So thanks again first to the organizers for inviting us to hear this talk. It's a pleasure to be here. So this is joint work with Joe Stiglitz at Columbia, who's also on the panel today. And the usual disclaimer applies. This doesn't represent the views of anybody else associated with the Federal Reserve System. So just to motivate this work, so as many of you know, the financial system is very concentrated with a small number of highly interconnected institutions kind of playing an outsized role across various markets. And this is generally considered to be a source of systemic instability because it concentrates risk among a few systemically important institutions or SIFIs. And so an important outstanding question is why financial institutions concentrate risk in a manner that generates systemic instability in the first place. And so in this paper, we propose a theory to help explain the structure of the financial system and to help show how it alters incentives to take risk. And so to this end, we build a parsimonious model of portfolio choice and crises, which features two key elements. So it features an interbank market through which financial institutions can exchange bilateral contracts. And it features a government which optimally intervenes during crises and lacks commitment. So in the model, banks will be able to choose the riskiness of their portfolios. And so the key mechanism that's going to be at play is that these choices about risk-taking will affect the structure of the interbank network, and also vice versa. The network structure will affect banks' risk-taking. And so the model will yield some insight into the relationship between systemic risk and interconnectedness. So let me first give a brief overview of the model. So broadly speaking, there's two.
Can I ask just a quick question? There's sort of an existing literature on this, including endogenous network formation. Can you just give a one sentence of what's the whole that you, or what's like specific to your model that we should?
Yeah, sure. So I was going to touch on that in a slide or two when I talk about the related literature.
Okay, no worries. Yeah, feel free to answer that. Yeah, thanks.
Okay. So broadly speaking, there's two components to the model. The first is kind of a standard collective moral hazard story. More precisely, banks will solve some portfolio choice between assets with different risks. There's also a possibility of fire sales, as in Lorenzoni. And then there's a government who's going to have limited commitment, kind of like Farhi Tirol, Acharya Mazak, etc. And so by themselves, these three elements would imply some standard collective moral hazard story in which the anticipation of government bailouts will lead to excessive risk-taking ex ante. So to this environment, this standard collective moral hazard environment, we introduce an interbank market through which banks can exchange bilateral claims. And this will imply that there's some relationship between interconnectedness and excessive risk-taking. In particular, the interbank market is going to facilitate some sharing of aggregate risk, and it's going to alter banks' portfolio choices, which is going to affect incentives to take risk. And it's also going to influence the government's optimal bailout policy by concentrating some resources in some banks. And so today I'll spend less time describing the details of these standard collective moral hazard elements, and I'll focus instead more on how the interbank market interacts with these elements. Okay, so before I get into the literature, let me just give a high-level summary of the results. So overall, the core periphery structure of the interbank market emerges in our model as a result of both rent-seeking and also risk sharing between banks. In particular, in the model, risky banks may endogenously become highly interconnected with other banks by issuing financial claims in the interbank market. And so from the perspective of the government, these risky banks are then too interconnected to fail, so to speak. In other words, they're systemically important, or SIFIs, and therefore they benefit from an implicit government guarantee on their assets, which ensures that they don't have to fire sell their assets during a crisis. So during a crisis, when banks' value returns the most, these SIFIs will benefit from a government bailout to cover their losses. And as a result, financial claims that were issued by these SIFIs will pay more than other risky assets. And so for peripheral banks, or banks who are not highly interconnected, this will make investing in financial claims issued by SIFIs a relatively good hedge against incurring losses during a crisis. And notably,
can I ask a question?
Sure.
So before going to the more details of the results, summary of the results, in the model, are there both portfolio choice and interbank claims choice, or just, yeah? Yeah,
exactly. So as you'll see, the portfolio choice will amount to choosing the riskiness of a project that you can invest in, or whether you want to invest in an interbank claim, which is backed by a different bank's risky project. So both of those will be part of the portfolio choice. That's right. So notably, SIFIs are the only private agents in this economy who can provide such insurance against crises, because only they are covered by the implicit government guarantee. So in this way, this concentrated structure will emerge in equilibrium with risky banks kind of at the core, and then less risky banks in the periphery. At the same time, though, this concentrated structure can also lead to or incentivize excessive risk-taking in two ways. First, it creates incentive even for peripheral banks to hold excessively risky assets, even though these peripheral banks themselves are never directly bailed out by the government. And the second way in which it alters risk-taking is that because downside risk is ultimately insured by the government, the interbank market will channel resources to the assets with the highest upside risk. And so as a result, it's going to be precisely the riskiest banks who become too interconnected to fail in this environment. So taking these effects together, interconnectedness and excessive risk-taking can reinforce one another in our model, as interconnectedness leads to the potential for crises by incentivizing excessive risk-taking, and this in turn makes lending to SIFIs relatively attractive, because the financial claims of these SIFIs are backstopped by the government. And so this dynamic between interconnectedness and risk-taking is one that exacerbates systemic risk in our framework.
A question: the goal of the interbank market is just to do like risk sharing, or there is some role of like funding, like some banks maybe don't have funds to invest in risky assets, so therefore they kind of borrow. Is there any channel like that going on, or just risk share?
No, so you're right, it's both. So as you'll see, so I'll lay out what exactly are the sources of gains from trade, but both of those are going to be at play. There's going to be gains to trade from exchanging aggregate risk or sharing aggregate risk, and there's also going to be gains to trade from basically increasing leverage in some, or at least increasing the pool of resources available to make investments.
One more quick question. So, I mean, I guess some of these concerns, are known by regulators, and as a result, like, the bigger banks are regulated differently. Are you going to think about that side of it, or is that going to come later?
Yeah, so that's exactly right. So this will hopefully help us think about optimal policy, both in terms of regulation of these highly interconnected banks, but also more standard what is the effectiveness of the types of regulations that have been implemented since Basel III, like capital requirements, risk-based capital requirements. So gotcha. This should hopefully have something to say about that, and I'll touch on that.
Gotcha.
Yeah. Okay, so just that's a good segue to the last slide before I go to the related literature. So we show that these equilibria are constrained inefficient because they feature excessive consumption risk. And then we characterize optimal policy and show that macroprudential regulation, which limits the interconnectedness of banks with risky portfolios, can improve welfare. And then we'll have something to say about policies which focus more on leverage, and that in this environment, they may be inadequate. Okay, so now let me touch on the related literature. Of course, our paper relates to a few different literatures, including this large literature on collective moral hazard. So in comparison to the collective moral hazard literature, most notably, Acharya and Mazar, Farhi and Tirol, here we're looking at a different margin of moral hazard, namely how these implicit guarantees affect risk sharing and interconnectedness. There's also a large literature on bank regulation and the too big to fail problem. In contrast to most of these papers, the SIFIs in our setting are going to arise endogenously through the interbank market. And then, of course, there's a large and growing literature on financial networks, to which many people on the panel have contributed. Also, a closely related paper is this one by Brianna and Sheng Xing, who are also interested in the interaction between interconnectedness and risk-taking. But of course, there's too many papers here to list on this slide. Our main departure from these literatures is the kind of jointly modeled portfolio choice and an element of network formation in the context of moral hazard. So while these individual elements have been modeled extensively in their respective literatures, the contribution of the paper comes really kind of from the interaction of these things. One thing that's also worth mentioning is that we abstract from frictions in the interbank market, which have been the focus of much of the literature on network formation. And as a result, while the model, the model remains tractable and is sufficient to kind of show to some extent how interconnectedness and excessive risk-taking may interact, but the network structure, of course, isn't going to play the rich role that it does in other models of network formation, including the ones on this slide. Okay, let me now get into the model. So there are 3 periods, dates 0, 1, and 2. All uncertainty is resolved in the middle period at day 1, and we only have aggregate risk. There's 2 types of goods, a consumption good and capital. And we also have, there's a representative risk-averse household who owns 2 types of firms. The household owns N different representative banks who make productive use of capital. And then the household also owns some traditional firms who operate a less productive technology. These traditional firms are just introduced to have some notion of fire sales as we go on. So at day 0, banks have access to 2 investment projects, both of which have constant returns to scale. So there's a prudent project, which has a risk-free date 1 return, denoted RC. And each bank has access to a risky project with a date 1 return, which varies both across states of the world and across the banks who are undertaking the project, which is indexed by I. So at date 1, these risky projects are hit by an aggregate shock, which determines the common component of returns across these risky projects. However, that common component loads differently across banks according to some parameter rho I, where rho I basically just determines how the aggregate shock affects bank I's risky return. So banks are heterogeneous in terms of the riskiness of the projects to which they have access through this parameter rho. Mu is just a constant which ensures that the expected returns of all projects are the same. And so basically a project with a higher rho is just a mean preserving spread of a project with a lower rho. Importantly, all risky projects offer the same expected return as the prudent project, but they involve higher risk. However, they don't compensate investors for that higher risk. And so by construction, all risky projects are excessively risky from a social perspective. And so the first best allocation will feature investment only in the prudent project. But we'll see that we deviate from that under certain conditions. Okay, turning to financial markets. So to finance.
Could you clarify what's the role of mu I?
Yeah, so mu I is just a constant which it ensures that the expected return of all of these risky projects is the same. It's equal to RC, the return on the prudent project. Okay, so to finance their investments, banks can raise funds at date zero from two sources. They can borrow from one another by exchanging bilateral contracts in a frictionless interbank market. And they can raise funds from the household subject to a limited enforcement problem similar to Lorenzoni, just adjusted to reflect that banks may have interbank exposures. So by separating the financial friction, which is needed for fire sales, from interbank contracts, which is needed to model some notion of interconnectedness, this modeling choice keeps the model kind of tractable. Yeah. Okay, so just to summarize the environment thus far, so we have a risk-averse household who owns n different representative banks. Those banks have access to some prudent project, which yields a risk-free return, and each has access to a risky project. And there's some notion of market segmentation in that each project, the project of each bank may vary in terms of its exposure to aggregate risk. To finance these investments, banks can issue interbank claims to one another, or they can borrow from the household subject to limited commitment. And then we also have some traditional firms who make less productive use of capital. And then later we'll introduce a government. Okay, so just first a note on the interbank market. So our interest is in how interbank risk sharing or sharing of this aggregate risk affects bank risk taking ex ante. And so for this, it suffices to consider this extreme case in which there are no interbank frictions. And so this is the baseline case that we deal with in the paper. But of course, because there are no interbank frictions, the network structure in the competitive equilibrium is going to matter only to the extent that it affects risk-taking ex ante. Okay, so in equilibrium at date zero, there's going to be a direct relationship between the structure of the network and the aggregate exposure of the banking sector to this aggregate shock. Okay, so what are the gains? Why are there gains to trade in this environment? Well, banks are heterogeneous in their exposure to aggregate risk in two ways. So again, recall that some banks have access to riskier projects. So there's some kind of market segmentation, which is represented by this parameter rho I. And depending on the government's optimal bailout policy, some banks may benefit from a government guarantee on their assets in equilibrium. So the interbank market is basically going to allow banks to gain access to one another's projects indirectly and to share the aggregate risk associated with this shock and also with the occurrence of the bailout. And the structure of this interbank network is going to be determined endogenously by the interbank contracts, which are traded in equilibrium.
Can I just ask a question? It seems like that there is no really role for interbank market to begin with, because if you shut down the market and if every bank would invest in a risk-free project, then everything will be fine, right? So in some sense, the first bullet point that you have, it's basically they're heterogeneous in the ability to do reshifting, right? So some can actually reshift more than others, and then they're all free ride on the government. So there is no, I miss here the gains from trade, don't exist in some sense. If you would have let's say higher return for risky projects, I will see how there's a gain. But the way that you set it up, it's only bad things coming from all this deal.
So okay, so let me clarify a couple of things. You're right that in the constrained efficient allocation, there's going to be investment only in prudent projects. There's going to be no gains to trade. That's true. when we we can have equilibria which do not feature that allocation, and in those equilibria, there's going to be gains to trade because the expected return to being exposed to some risky projects is going to be larger than the prudent project. And you're right that ultimately comes from this risk shifting problem. But it's important to note that the extent to which the banking sector as a whole can expose itself to this, can facilitate this risk shifting problem is going to depend directly on the structure of the network ex ante. So the structure of the network is not going to play a role ex post, in terms of contagion or things like that, but the structure of the network is going to determine exactly what the nature of this risk shifting problem is and which banks can do this risk shifting problem.
Can I just say one thing? The conjecture that the interbank market doesn't serve any social purpose is actually one of the results we'll come to, that if you shut it down, things are better. But I think that's actually true of the interbank market that we actually have. So I think it actually captures something about what the market that we have, and that's what we're trying to do in the paper.
Okay, so let me talk now more about the interbank contract. So an interbank contract between the two banks, Bank I and Bank J, involves a loan of L units of the consumption good from Bank I to Bank J at date 0 in exchange for some state contingent payments R at date 1. And so for the contract to be traded in equilibrium, it has to satisfy some participation constraint to incentivize Bank I to lend to Bank J, where the participation constraint takes the following form. So UIJ here on the left is the value of the Bank I if it accepts Bank J's contract, while U bar I on the right hand side is Bank I's reservation value, or in other words, the value of Bank I if it invests in its next best alternative. So that could be either lending to another bank or investing in a project on its own behalf. And so this reservation value, U bar, is going to depend on what other banks are doing in equilibrium. So that's going to, and it'll also depend on the government's optimal bailout policy. So so we'll have to return, so this reservation value is going to be pinned down only in general equilibrium. I forgot to mention that, so contracts, these interbank contracts are traded competitively. And so an optimal contract is going to just equate the return on an interbank claim in each state with the issuer's portfolio return in that state. And so in equilibrium, the interbank market is going to yield full risk sharing between banks, and it's going to channel funds to projects which generate the largest private circles. Okay, turning to the contract between the household and banks. Again, this looks very similar to Lorenzoni, so I won't go into detail, but banks raise funds from the household subject to some limited enforcement problem. This limited enforcement problem introduces a borrowing constraint in which the promises to repay that the bank can make in any state should not exceed the liquidation value of the bank in that state, where this liquidation value depends on the value of the bank's assets, including its net exposures on the interbank market. So the main takeaway here is that this financial constraint is going to be the friction that opens the door for fire sales to occur in the bad state.
Can I ask a clarifying question? And apologies if you mentioned this, but in the introduction, you talked about CFIs, and I don't think you've mentioned them yet. Is it going to be the banks with the highest exposure to the aggregate risk, the highest row I, that are going to emerge as what you're going to call CFIs in your model? Or am I getting that wrong?
That's right. The reason I haven't mentioned it yet is because that's going to, whether or not there are these highly interconnected banks in equilibrium, and which banks end up becoming highly interconnected is going to be a result of that's going to only emerge in general equilibrium. So it's going to be entirely endogenous. So yeah, so I'll that's why I haven't. That's why they haven't appeared yet. They'll appear only in general equilibrium. Okay, and so turning to the bank's problem at date zero. So at date zero, each bank is going to choose on the asset side how to allocate its portfolio between the prudent project, its risky project, or interbank claims. While on the liability side, it chooses how much to borrow from the household and the contracts to offer the banks. And it makes these choices to maximize its value, which is just the present discount, or the discounted, the expected discounted final profits, so day two profits, subject to the participation constraints, subject to limited enforcement constraints, and also to the budget constraints. So this is the date zero budget constraint. The right-hand side of the constraint just shows the funds that the bank has available at date zero, which is just some endowment of for the consumption good, the amount that it raises from the household, and then the amount that it raises from other banks J in the interbank market. On the left-hand side is the expenditure, which is investments in the risky asset, the prudent asset, or interbank claims to other banks J. So in general, because banks are owned by a risk-averse household, they face a risk-return trade-off for each asset type. So the value of each asset to a bank is going to depend, is going to command some risk premium, which just reflects the covariance between the discount factor and the return on the asset. But it turns out that although in general there's this risk-return trade-off, in equilibrium, each bank is always at a corner solution in its portfolio choice because of the constant returns to scale of the technologies that are available to it, and because of the absence of idiosyncratic risk. So in other words, in equilibrium, a bank is either going to invest all of its resources in the prudent project or the risky project, or it's going to forego these projects altogether and invest in in an interbank claim issued by some other bank on the interbank market. So for example, in deciding how much to invest in the risky project versus the prudent project, bank I will compare the expected discounted return of each project and then invest entirely in whichever one is larger. So this is effectively the first order condition for choosing its investment across these projects. So in equilibrium, each bank will invest all of its funds in the asset that it values the most. But again, which asset a bank values the most is going to depend on the interbank contracts that are available and the government's bailout policy in general equilibrium. So again, in order to pin this down, we have to return to it in general equilibrium. So a corollary of the fact that the banks are at a corner solution is just that in equilibrium, only a subset of banks are going to be making real investments in one of these projects. And those banks, the ones who are making real investments, we can call them investing banks. These are the banks with access to the highest value projects as measured by the expected discounted return. So note that depending on the government's optimal bailout policy, some assets may benefit from an implicit guarantee, an implicit government guarantee here represented by G, and that's going to affect the value of the asset. So while some subset of banks will be making real investments in projects, the remainder of banks are simply going to be intermediating funds from the household to these investing banks.
Would the same force be there if instead of government guarantees, you would have that the expected return of the risky asset is higher than the risk-free rate?
Sorry, I missed the beginning of the question.
So if the expected return of the risky asset is higher than the risk-free rate,
right?
Would that be a substitute force in the model for government guarantees?
So in terms of what's written on this slide in particular, it would, in that there would still be on. So banks will be at a corner solution regardless, and which banks ultimately end up investing in real assets is going to depend on the expected return. So in that sense, yes, but the fact that so it would not substitute for a government bailout. As we'll see, the government bailout policy is going to be an optimal choice, and the government is going to want to bail out only particular banks, and that's going to affect ex ante how they share risk and how they invest with one another.
But from the perspective of this slide, it's just basically
Yes, yeah.
in terms
That's
of the value for the investor, for the households, and hence for the banks.
Yeah,
comes
exactly. Right, right.
So, sorry, can I just ask you a question on the identical payoffs? So if in equilibrium, some banks are going to be SIFIs, how should we think about them still trading competitively on the interbank market? Like, should I think about like a Fed in the background that's injecting liquidity to offset any market power that a systemically important bank might have? Would you think of that as part of the government policy?
Yes, that's a good question. Just in purely technical terms, in the model, each of these banks, so bank I's, these are each representative banks. So they consist of a continuum of identical atomistic banks. So when I refer to SIFIs, I'm referring ultimately to a systemically important representative bank. So you can think about that as, in some ways, at some level, there will be multiple systemically important banks in a given sector I. So in the background, that's how the competition is reconciled with the fact that there are going to be these SIFIs in equilibrium.
But so then they might not have, let's say that means that they don't have market power over each other, but they in principle could have market power over someone in the periphery who's not a SIFI.
Yeah. So, well, in the model, no, but I take your point that in practice, these SIFIs, just by virtue of their size and their importance, they obviously have market power. That's in principle an important dimension that may interact with these forces here, but that's something that we're abstracting from. So all banks are competitive, even those in this systemically important sector I.
Just
Another
last
way of
question.
thinking about it is, another way of thinking about it is that everything here is scale free. So you can just increase the scale. And the critical thing here that's different from some other models is that the risk is, there's this systematic risk, S, that, so it's the correlated risk that we're focusing on. So they're systemically important, but they can still be, relative to the whole economy, not that big. But they're all going to go bankrupt at the same time. So the government will intervene.
Okay, and so then maybe that's the thing, that part of the, I don't want to call it bailout policy, but part of the government policy is, when it comes down to it, if these guys were to have a negative price impact on the interbank market, there would be some liquidity injection that might offset it. So we can think of them as not having much impact on the prices.
Yeah, you could interpret it that way. Yeah, I wouldn't object to that. Yeah. Thanks.
Just one other quick question. Do you need the bailout to have incentive to risk shifting? Isn't the standard shareholder, bondholder enough to generate that?
So, of course, in general, there may be a risk shifting problem in practice due to some misalignment of incentives.
No, in the model, I mean, in the model.
No, in this model, so the incentives of the claim holders, so households or depositors, if you want, and the banks themselves, those are perfectly in alignment. So the risk shifting problem doesn't apply here. There's no risk shifting problem at the level of a bank. It's at the general equilibrium level at the banking sector as a whole. And it's a risk shifting problem from the banking sector as a whole to the government. So you would not get the same, any risk shifting problem between depositors and shareholders would not generate the same results that we're getting here.
But that's
Okay.
because you are limiting the payoffs on the debt to the sort of safe part, or is that?
I'm sorry, can you say that again?
Has this to do with the fact that you're limiting the payoff to the debt holders? I don't know, maybe that has to do with your limited commitment constraint. No, that because in principle, if I can take more risk, I can pay less to debt holders. That should give me an incentive to take risk. Unless I can always, I'm limiting that so that I always pay the same, and then of course I don't have it.
Yeah, so effectively, yes. So effectively, because banks are competitive here, the return that they pay on their interbank claims or their claims to debt holders is going to be pinned down entirely by their portfolio return. So there's what that means is that the incentives of shareholders and bondholders are going to be perfectly aligned. I'm not sure if I made that
Okay, well, okay.
Can I ask?
Just a follow-up question. Sorry, Michael, just quickly. So follow up on Piero's question. So here, if the government subsidy is 0, would there still be this moral hazard risk taking, or?
No.
Okay, so it's mainly because of that. Not
Exactly.
like okay.
That's right. It's entirely because of the implicit guarantee from the government.
And the government can't commit itself not to. It will be optimum for the government to make that intervention.
So a related question, that the funding of the bailout, is that coming from the households or is that outside of the model?
Yeah, so in a few slides, I'll get to the government's problem, but yes, bailout will be funded from using lump sum taxes on the household. Okay, so let me just say one last thing on this slide. So recall we have banks who are going to be doing some subset of banks who are going to be investing in projects, and the remainder of banks just intermediating funds from the household to these investing banks. But because interbank loans are all backed by the same projects, all banks are going to have identical payoffs in equilibrium, regardless of whether they're investing or intermediating funds. And that payoff is just going to be the portfolio return of the investing bank, which consists of the return on the investing bank's project and any potential transfers from the government, which will be pinned down by the government's problem. Okay, so everything that I've said until now applied at date 0. So moving to date 1, so banks have made their portfolio choices, their investments in projects and interbank claims. Moving to date 1, risky projects are hit with the aggregate shock. In the bad state, banks who are suffering losses on their investments have to sell their capital holdings to finance their losses. If the aggregate losses of the banking sector are high in aggregate, then we have a fire sale or a crisis in which banks effectively have to fire sell their capital to the traditional sector who make less productive use of capital. So when many banks are suffering losses simultaneously, we have this type of crisis, which leads to a costly misallocation of resources because capital is employed less efficiently thereafter. So this is a kind of a similar story as in Lorenzoni, with the exception that whether or not a crisis actually occurs is going to depend on how on the strategic interactions of banks.
Is it possible for certain banks to wait until date 1 and acquire these assets? I mean, they can make productive use of these assets relative to the traditional sector.
Yeah, so that's possible. That can happen off equilibrium. So in other words, suppose that all banks are exposed to the aggregate risk, then I may have incentive to invest in only the prudent asset, so that moving into day 1, if there's a bad shock, I have funds available to buy capital cheaply. So that can happen off equilibrium. It turns out that doesn't happen in equilibrium.
Is that because of the bailouts, or does that exist even without the bailouts?
No, so that will that will be because of the bailouts as well. Yeah. Okay, so with that, we can turn to the government's problem. So the government is benevolent, so it wants to maximize household welfare. And we assume for now that it can intervene only at date one. So for now, we'll leave aside date zero, macroprudential tools, and we'll return to those later. So the government, a government which wants to maximize household welfare at day one, is going to choose taxes and transfers at day one to maximize household welfare, taking as given agents optimizing behavior. And it's going to face a standard budget constraint, which basically is, so G bar is a transfer to bank I in state S, conditional on the bank's portfolio and the state of the world. T is lump sum taxes on the household at day one, which are used to finance the bailout. So importantly, the government lacks commitment at date zero to implement policies at day one, which are suboptimal. In other words, the government will not be able to commit to letting highly interconnected banks, for example, fail during a crisis. So again, this is a key friction in the collective moral hazard literature. Another key friction necessary for there to be this collective moral hazard in equilibrium is that bailouts can only be imperfectly targeted across banks. So this has a flavor also in Farley and Tirole. So, as has been shown in those papers, if the government could perfectly target bailouts to some banks and not others as it sees fit, then the government in principle may be able to undo any perverse effects of the bailout on ex-ante incentives. So, a key friction necessary for there to be moral hazard and equilibrium is that there has to be some constraint on the government's ability to target the bailout. Here, we assume that banks cannot be bailed out on the basis of the losses that they incur on their holdings of interbank claims. So in other words, the government has to verify a bank's losses before it can bail out the bank. But the government can only verify losses that a bank incurs on its own investments in projects and cannot verify losses that it incurs on its holdings of interbank claims. So how does one interpret this assumption? Well, in practice, the exposures that financial institutions have to one another are often off-balance sheet exposures, and they're often opaque. And so the losses that these banks incur on these types of exposures can be difficult to quantify or verify during a crisis. And so, this assumption can be interpreted as capturing that type of opacity. Okay, so what is the optimal bailout policy at day one? So if a fire sale crisis occurs at day one, the government's optimal policy is to bail out banks who are suffering losses on their investments in order to prevent this misallocation of capital that happens in a fire sale. The optimal total size of the bailout is just enough to prevent the fire sale from occurring and is equal to the aggregate losses of the banking sector as a whole. So that pins down the total size of the bailout. It turns out that the government at day one is indifferent about how those bailout funds are distributed across investing banks, because essentially the distribution of resources across banks ex post has no effect on future output because of constant returns to scale. And therefore it has no effect on household welfare. So at day one, the government is indifferent essentially about how it distributes the bailout across investing banks. Of course, in general, how the bailout is distributed across banks may affect their ex-ante incentives at day zero, but it turns out that it largely doesn't affect their ex-ante incentives because of full risk sharing between banks at day zero. So the fact that we have full interbank risk sharing means that regardless of how the government distributes the bailout across investing banks ex post, all of these investing banks are going to be able to benefit from the bailout at day zero, at day one. But in any case, for concreteness, let's consider that we just consider the case in which each investing bank W is bailed out in proportion to its total capital holdings. So the transfer to bank W in a crisis is going to just be the total size of the bailout times that bank's share of total capital holdings. Okay, so let's now take a look at how the government's optimal policy affects banks' decisions at date zero. So in other words, in making their date zero portfolio choices, banks are going to take into account the government's optimal policy. So they're going to anticipate that in certain situations, there's going to be a bailout. Since a bailout occurs in a bad state, only if aggregate losses are high enough to trigger fire sale, there's a strategic complementarity in banks' portfolio choices at date zero. In other words, other banks' portfolio choices will determine whether or not a bailout will occur in the bad state, and therefore whether or not some risky assets will benefit from an implicit guarantee. And so for that reason, we can split the bank's date zero investment decision into two cases: when the conditions for the bailout to occur in the bad state are satisfied, or when they're not satisfied. So if aggregate risk-taking is low, so that a bailout is not anticipated to occur in the bad state, then the expected discounted return of any risky asset is strictly less than that of prudent assets by assumption, basically. I had showed you the assumption in the beginning that the expected return on any risky project is equal to the return on the prudent project. So if aggregate risk taking is low, then risky assets are too risky for any bank to invest in. And so the bank only invests in prudent assets, which are either the prudent project itself, or it invests in interbank claims, which are backed by the prudent project. So this basically characterizes the bank's best response function at date zero in the case where aggregate risk taking is not sufficiently high to trigger a bailout in the bad state. If, on the other hand, aggregate risk taking is high, then the anticipated bailout puts a floor on the return to risky assets, which benefit from the bailout. And in that case, the expected discounted return from investing in these assets will exceed those of other assets. And so banks will find it optimal to invest only in risky assets that benefit from such an implicit guarantee. So this characterizes the best response function when risk taking is high. I may need to speed up slightly. So turning to general equilibrium, there are two subgame perfect Nash equilibria at date zero. They're taking into account these best response functions. In the prudent equilibrium, all banks are investing only in prudent assets, and so crises and bailouts never occur. No bank is sufficiently interconnected to be bailed out. In the risky equilibrium, the riskiest banks, in other words, the banks with the largest row, are the only banks who invest in projects. All other banks will forego their own projects to invest in claims issued by these systemically important banks. And so as a result, these riskiest banks become too interconnected to fail from the perspective of the government. In other words, they're SIFIs. So in this way, all peripheral banks, in other words, banks who don't benefit directly from a bailout, are going to have maximal exposure to excessive risks indirectly through their claims, through their holdings of claims issued by SIFIs.
Is it correct that if you increase the return on the risky asset, you can rule out the prudent equilibrium?
Yeah, that's right. Yeah, you would. Okay, so let me now discuss how interconnectedness and risk-taking interact in general equilibrium, focusing on the risky equilibrium. So in the risky equilibrium, the interbank market's concentrated structure, the fact that we have these risky banks at the core, enables banks to share crisis risk in a privately optimal way. How does that work? Well, in equilibrium, SIFIs issue financial claims to other banks, and during a crisis, when banks value returns the most, the SIFI's claims pay out more to its claim holders than what it earns on its own investments. And therefore, it's effectively providing insurance against crisis risk, against losses during a crisis. In other words, so the return on an interbank claim issued by a SIFI W to some peripheral bank I is going to be, in the bad state of the world, is going to be the return on the SIFI's assets, which will be low, plus some additional component, which effectively is insurance. In equilibrium, this level of insurance is just going to be equal to the bailout that the SIFI receives on its own assets. So as a result, basically, these financial claims that SIFIs issue are a relatively good hedge against incurring losses in a crisis. So in this way, the interbank market basically transfers downside risk of risky assets from peripheral banks to the SIFI. And again, SIFIs are the only private agents who can provide this insurance because only they're covered directly by the government guarantee. So how does this risk sharing affect the structure of the network? Well, since a financial claim which is issued by a SIFI is backed both by the risky asset and also implicitly by the government guarantee, it provides both insurance and also provides a higher upside return in the good state compared to other risky assets. And so as a result, the financial claims that are issued by SIFIs are going to command both a higher expected return and a lower risk premium than other assets. In other words, the covariance between the discount factor and the return on a SIFI claim is going to be higher than it is for other assets. And so as a result, banks are going to forego their own investments to invest in claims issued by the SIFI, and that's precisely what generates this corporate free structure. So in other words, this corporate free structure is the result of both this rent seeking and also this sharing of crisis risk between SIFIs and peripheral banks. We also show that this concentrated structure of the interbank market alters risk-taking behavior of banks in two ways. So the insurance offered by a SIFI's liabilities creates incentive even for peripheral banks to hold excessively risky assets, even though they're never directly bailed out by the government themselves. And as a result, what that means is that effectively the resources of all banks, and not just those of the SIFIs themselves, are channeled to excessively risky projects. And so in this way, the exposure of the banking sector as a whole to excessive risks is increased. And second, since downside risk is implicitly backstopped by the government, the interbank market is channeling funds to investments with the highest upside risk. And as a result, it's precisely the riskiest banks who become too interconnected to fail. And so in both of these ways, the concentrated structure is going to exacerbate excessive risk taking in equilibrium.
Sorry, I'm noticing I'm having trouble understanding one thing. So in my mind, I've been thinking, this is going back to Michael's comment earlier, that basically the banks that are most able to extract rent, which are the ones with the highest exposure, they're going to invest, everybody lends to them, that jointly they maximize the value of this arbitrage that the government is offering them. But that seems to conflict with your notion of risk sharing and insurance, which seems to suggest that they're all facing this aggregate risk, and the banks who face it the most are somewhat insured by the ones who face it less. So am I misunderstanding something, or?
So effectively, there's kind of two things going on which are related. On the one hand, there is a risk shifting problem from the SIFIs, shifting the risk of risky assets to the government. That risk shifting happens because SIFIs benefit from a bailout according to the government's optimal policy. But on top of that, there's a type of risk sharing between banks who do not benefit directly from a bailout and those who do. And that happens basically through the interbank market. So by exchanging these contracts, the SIFIs are absorbing losses. In other words, they're absorbing downside risk from the balance sheets of these peripheral banks. And they're precisely able to absorb that risk because of the advantage that they have in shifting that risk to the government. So effectively, there's some risk sharing between peripheral banks and the SIFIs, and then a risk shifting problem between the SIFIs and the government. So another way that you can think about it is that the government is ultimately providing insurance to these SIFIs, and the SIFIs are kind of intermediating that insurance to the rest of the banking sector.
So in the crisis state, the bailout funds go to the SIFIs, and then they, in repaying their borrowing from the peripheral banks, pass along this insurance payment that comes from the government and then flows through in reverse. It's sort of the lending, first the funding flows to the SIFI banks, and then in state of crisis, the government payout flows in reverse along the same network.
That's right. And that's a direct result of the way that these contracts are pinned down. These interbank contracts are pinned down in equilibrium. And it's also a direct result of the government's optimal bailout policy in equilibrium.
One question about, I'm trying to kind of understand exactly how the households are internalizing this lump sum tax at date 0 when they're actually lending to the banks. Can you speak a little bit about how that's affecting the borrowing constraints of the banking sector?
Yeah, sure. So let me start by saying the externalities here are all the general equilibrium level. So banks banks and their depositors fully internalize that by investing in risky assets, they're changing the payoff profile to both the banks themselves and the depositors. So the banks are acting in the best interests of their depositors. However, individual depositors or individual banks don't internalize that in general equilibrium, how their risk-taking affects consumption in aggregate, and therefore they don't internalize how their risk-taking affects the stochastic discount factor in general equilibrium. So the household presumably could make its contract to the bank contingent on the bank's investment. So it could, in some sense, an individual depositor, may say, I'm only going to lend to you if you invest in prudent assets. But that's suboptimal in equilibrium because that household doesn't internalize that that risk-taking is going to ultimately affect aggregate consumption.
Would this problem somehow be alleviated if households had limited resources, and then at some point, if they lend in time 0 too much, then there's not enough money that the government can collect to do bailouts? So it kind of like would introduce some commitment not to bail out.
Yeah. So if I think that's true, if the losses in the bad state were sufficiently high relative to the resources available to be taxed, then that would probably break the equilibrium because there would be no way to finance the bailout.
I think the result still would be the same. It just wouldn't be as much risk sharing. It still would be that you would get an inefficient equilibrium, I think.
Yeah, I think that's right. Yeah.
Okay.
We got 1 or 2 minutes to wrap up.
Okay, let me just go very quickly then. So taken together, there's kind of an interaction between the interconnectedness of the financial system and incentives to take excessive risk through these channels that I just laid out. So basically, the fact that the resources of peripheral banks are invested in excessively risky assets leads to increases the exposure of the banking sector to excessive risk, and also the fact that the SIFIs are endogenously the riskiest banks also increases excessive risk taking, and in turn, this excessive risk taking leads to crisis risk, for which peripheral banks, desire insurance, and so that leads to incentive to invest in the claims of these SIFIs, which leads to interconnectedness. So in other words, without interconnectedness or without excessive risk taking, the economy would not support a risky equilibrium. It's really the both of these two things which allows the risky equilibrium to take shape in general equilibrium. Yeah, then we go into some normative implications. So, in a risky equilibrium, welfare is lower because consumption volatility is too high. This has to, we go into the externalities, which I've already touched on somewhat. And then finally, let me just finish with some macroprudential policy. So we show that the risky equilibrium can be eliminated using some Pigouvian taxes on lending to banks who hold risky portfolios. So basically, a tax which inserts a wedge between the marginal rate of substitution between SIFIs and peripheral banks can eliminate the risky equilibrium. And effectively, this tax is basically preventing banks with risky portfolios from becoming too interconnected to fail. And so that forces banks, both peripheral banks and also the SIFIs, it forces them to internalize the social costs of their risk taking. And then the last slide is, so we touch on some practical considerations in the model. So, policy tools designed to reduce interconnectedness can be beneficial in this framework. There are a couple of examples of those, including the US. Policies which reduce bank leverage are by themselves inadequate because the inefficiencies here are coming from the asset side. But in general, it's also worth noting that optimal policies that we outline in the paper may be difficult to implement in practice because it requires the regulator to have a large amount of information on the exposures that financial institutions have with one another. It also requires that they be able to identify which risks are socially excessive, and those are perhaps infeasible in practice. So although we don't get it into this paper, this kind of points to alternative regulations like structural regulations that prevent banks from being able to undertake correlated risks. It suggests that those types of policies may be fruitful. So I'll let Joe, if he wants to elaborate that on the discussion, I'll let him do that. But we don't get too much into it in the paper. Oh yeah, and so just to conclude, we developed this model of portfolio choice, bilateral exposures, and crises, which hopefully yields some insight into the relationship between interconnectedness and systemic risk, and the roles that these systemically important institutions may be playing in intermediating the insurance benefits that government bailouts have to the rest of the economy in a way that exacerbates excessive risk taking. And I'll just stop there.
Thank you. Now we have a 15-minute open floor discussion. As a panelist, you can just unmute yourself if you like, and as an audience, you can either use a Q&A function or just use a raise hand function, and we would like to talk.
Just one question on the point you made about taxes. If you shut down the interbank markets altogether, what would happen?
Yeah, so in this environment, if you were to shut down the interbank market, there's two possibilities depending on what the government does in a crisis situation. If the government found it optimal to bail out, say, all banks who are suffering losses in a crisis, then you could still have a risky equilibrium in which all banks undertake their own risky projects, because here their risky projects are all perfectly correlated, and so they will all still fail in the same state of the world. It would be like a too correlated to fail problem. Acharya and Yorulmazer had this flavor. However, if the government could design a bailout optimally, one which it can commit to basically force banks, at least some banks, to internalize the cost, the riskiness of their investment decisions. In other words, if the bailout could be designed in a way which forces banks to bear their losses, or at least some of them, then that could eliminate any risky equilibrium, and you would be left with only the prudent equilibrium. But in general, you can still, you could still have an equilibrium with excessive risk taking because banks are may be able to
But
correlate.
the Pigouvian taxes you described, they are preventing, so they are shutting down the interbank market effectively.
So they're shutting down. They're not shutting down the interbank market. They're simply exacting a cost on lending to banks if those banks have excessively risked portfolios, and if aggregate risk taking is sufficiently high to trigger a crisis in the bad state. So it doesn't prevent all interbank lending. It just ensures that banks internalize the social cost of lending to SIFIs who have risky portfolios.
Antonio, you can go ahead.
Hi. So I have a couple of questions. One is touches again upon what Piero was saying earlier. So this taxing of risky portfolios sounds like something very difficult to do. It should be very hard to know exactly what's a risky firm, ex ante or not. I think you said it in the end, but I was, yeah. The other thing, kind of more generally, you presented this as a sort of network paper, but it's difficult to see the network dimension. No, it's a bunch of firms that are investing in others because they're more risky, and you call it core periphery, but it sounded like it's a bunch of firms investing in a bunch of other firms. So there's not much of a network structure here that I could see, but maybe I missed something.
Yeah, so I'll just start with the second point first. So, so you're right that it's not a typical paper on network formation, in the sense that the network topology plays a limited role here. Basically, we can fully characterize the equilibrium allocation with with a sufficient statistic. Who are there interconnected banks, and who are those banks? Aside from determining which banks are, highly interconnected and that they've issued, financial claims to other banks. Aside from that, the network topology is irrelevant for the allocation. So in that sense, there's an element of network formation, but of course and I said this in the beginning, I wouldn't want to overstate the role that the network topology plays here. It plays a role in a limited dimension, and it plays a role only to the extent that it affects the exposure of banks to aggregate risk ex ante. And your first point was the practical limitation. Yeah, so this is something that I touched on at the end. So I agree with you that it may be infeasible to implement the policies outlined in the paper that would be required to eliminate the risk equilibrium, precisely because of the things that you mentioned. It requires the regulator to know how financial institutions, including non-banks, have how they're exposed to each other, including off-balance sheet exposures, et cetera. And that's something that's regulators typically don't really have, at least not on a real-time basis. And second, it requires them to be able to identify, or at least have some notion of what risks are socially excessive. I agree with you that presents practical limitations, and that's why, as I stated at the end, we don't get into the paper, but the paper kind of points to alternative types of regulation, like structural regulation, which would make the financial system more robust to risk taking, and also would potentially reduce the ability or the incentive of banks to undertake correlated risks in the first place. Again, that's something more that Joe might want to speak about, but
let me make just one comment. I mean, one of the peculiar things about interbank lending is that if you have households that have optimally diversified their portfolio across banks, the question is, why doesn't that suffice for risk sharing? You know, why do you have to have risk sharing both at the level of the ownership and the banks lending across themselves? And there's part of the answer has to do with bankruptcy costs. But the other part of the answer is what is going on is, in fact, the kind of trickle down mechanism of getting for the periphery banks getting the bailout premium from the core banks. And if that is what is going on, then if that's the core issue of what interbank lending is, especially in the presence of the Federal Reserve as the lender of last resort, solving the liquidity problem, then it suggests a role for stronger structural policies to limit interbank lending. So it's a beginning of asking the question, what is the function of interbank lending?
Thanks, both.
Oh, Anna, you guys can go ahead.
Thanks. So first I wanted to make sure I understand the right forces in the model. So even in the absence of government guarantees and of an interbank market, there is still this option value of taking risk from the side of the bank, right? That is only the bank benefits from the upside risk without having the fee being exposed to through the nature of the debt contract is not exposed to the downside risk, right?
No, not quite. So in the absence of any government to issue bailouts, banks would be forced to internalize, to bear the losses of their risky investments in the bad state. And so they would internalize the riskiness of those investments ex ante, and there would never be incentive in this setting, in this simple setting. There would never be incentive to take anything, to invest in anything other than the prudent project or claims backed by prudent projects.
So then the government guarantee brings this out, this option value. Basically.
Exactly. Yeah.
No, I mean, the point is that they would have to pay higher interest rates on their deposits that would offset the option value. So it's because of the endogeneity. A lot of models take the interest rate, deposit rate as fixed, and then you have an option value, and then you're cheating the depositors. We have an equilibrium model where there's full rationality in the design of the contract, so you can't cheat the depositors.
Okay, but the government guarantee basically now allows you to cheat on the depositors, so it's kind of okay. And then the interbank market, that essentially it adds yet another layer in which the upside risk, if you want, of the bank is even higher now, or it limits even more the downside risk. So the interbank market limits even more the downside risk. So that's
again, the contracts are endogenous, so that's fully internalized. The only part that's not internalized is the government bailout, and that's because of the assumptions that we've made that the government can't make bailouts that are, for instance, contingent on your behavior, which is the inherent property of any moral hazard.
Now, the government will have yet another tool, which I don't know, I may have missed whether you're exploring it in the model, but it can set the interest rate, right? So if the government can act both with bailouts and interest rates.
Oh, in this model, the government is not a lender. It's just a bailout. That's the only, Levent, do you want to, it would be a big change in the model to have them.
So, Anna, tell me if I interpret your comment correctly. So you're saying that in principle, you know, abstracting from direct bailouts, the government also has lender last resort or monetary policy tools, which
policy tools, yeah.
Okay, which can also basically serve a similar function. I think that's right in principle, and that was the focus of like Farhi and Tirol. They focus specifically on monetary policy and lender of last resort facilities. So I think the principle would be the same as long as there's really the key is that the government needs to have a limited ability to, to target bailouts to specific banks. Otherwise, it could design some transfer which forces banks to internalize the costs of their risk.
Okay, thanks.
Yes, Michael looks like he had a comment.
Yeah, maybe I can ask one question about Joe's comments, actually. So, which is what is the benefits of interbank lending, for instance, if we let banks to form endogenously this kind of core peripheral structure? So in your model, yet yes, so this core peripheral structure emerges, but there are various ways we can think how government can regulate, right? So in some sense, what Joe told us was that if there is this, if we let banks to form core peripheral structure, and if that's not good for the society, then we should ban interbank markets. But was that like that kind of an approach, or otherwise there might be different regulations on the network structure, one thing, or another thing is like limiting the interconnectedness to up to some level, or maybe in some cases that might be also helpful to allow. So what would you think about it? Yeah.
I think I understand the point that you're making. So one thing that is worth emphasizing is that the model is very parsimonious on purpose. So the interbank lending in this framework in equilibrium only serves socially costly functions, right? That's not to say that there are no social benefits to interbank lending in practice. We've abstracted from those alternatives just to focus on kind of this other insight that we're trying to draw out in the paper. But in principle, any regulation on the ability of banks to interact in these markets would have to trade off both the social benefits and the social costs. Here we've abstracted from the social benefits; those are taken up in other papers in the literature. But we just wanted to focus on this social cost, which doesn't seem to come out in the literature yet.
Yeah, and let me just say, it was partly motivated by my own sense of the social benefit being limited. There is a risk-sharing social benefit, which in what I said was that the magnitude of that depends on how well the capital market is working. If you've diversified the ownership of banks, there's very little, among households, there's very little benefit. The only benefit then comes from bankruptcy costs. And in the presence of a good lender of last resort, bankruptcy doesn't happen very often. And then the question is, if that's the case, is what is going on in the interbank market really what we've tried to model in this paper, a trickle down of a sharing of the bailout rents. And in that sense, the social cost is very apparent. The social benefit is much more limited. And if that's the case, then that moves you towards policies that limit interbank lending and subject interbank lending to more scrutiny. So it's really trying to construct a broader picture of, begin a discourse over the benefits, social benefits and costs of interbank lending. What is really going on? And I think the question of what is really going on hasn't been adequately addressed.
Can I ask a question about this assumption of competitive kind of market in the price setting on the interbank market, it looks like that basically, like if you would give CFIs like bargaining power, it's not clear that it would make like welfare kind of go down. It seems like that it could actually improve welfare, because if CFIs take all the surplus, then peripheral banks will not want to kind of maybe lend to them, and then somehow maybe it's going to be like undo some of this kind of steroid like effect of this interbank market. It seems like that in general you have this reshifting, and then interbank market is just makes it a little bit more. So like maybe it will push back a little bit, but I don't know if it's true. Just a conjecture.
Well, that's an interesting point. I think you're probably right that if these SIFIs have some market power, which allows them to extract surplus or rents from these other interbank markets, that may be a force in the opposite direction. You're limiting
But it would only limit the extent to which the distortion occurs. It would say there's not, in our paper, there's full trickle down of the government, and we get all the households get to lend to all the risky assets through a trickle up through the SIFI banks, and this would have less of the trickle up. It would divert more money in a more general model towards the big banks, and so that would undo some of the benefits. But you're right, it would limit the amount of trickle down that you get through the SIFIs.
Yeah, it just depends on the outside option. So that, like, I'm not sure. Maybe in the end of the day it will be the same. It just needs to be a little bit. But it's just interesting, like, to do this comparative statics, just for toy model, maybe. Then.
Yeah, interesting.
I will end a recording here, but we can still stay and keep discussing. Thank you.